Hello ladies and gentlemen, what I'm going to do with you today is I'm going to have a look at transactions. We're going to look at the documents that these transactions are recorded on. We're going to look at journals, and we're going to record these transactions in the accounting equation table. We've done this already, but now what I'm adding to this table two columns: which journal is used to record the transaction and which document is used to record the transaction. We will also look at whether the document is an original or a duplicate. This is an important video lesson. We're building on prior knowledge. We've already looked at which account is debited and which account is credited and the effect on the accounting equation, but we're adding a little bit more. The documents, whether they the original or duplicate, and which journal is used to record the transaction we're looking at. So let's move on. So we're looking at transactions, nothing new there. We're looking at which documents. We're going to go into more detail with the documents. Which documents are used to record these transactions: receipts, invoices, debit notes, credit notes, bank statements, petty cash voucher, journal voucher. So we'll look at the documents, EFT confirmation slips. We're going to use those documents and we're going to record the information in the appropriate journals. And then also what happens, from the journals, the information is posted to the general ledger on a monthly basis. We're going to look at a debtor and a creditor. So that's accounts receivable and accounts payable. We're going to look at one client, one customer that we've sold to on credit, and we're going to look at one customer or one supplier that we've bought from on credit, because we're going to receive money from a debtor and we're going to pay a creditor in this exercise. The first journal that we're going to look at is the cash receipts journal. You may have previously called it the cash book receipts, but cash receipts journal is used in the textbook we're using. Now, cash receipts journal will record any transaction that results in the bank balance of the business increasing. So any transaction that results in the bank balance of the business increasing will get recorded in the cash receipts journal. For example, services rendered for cash, a cash sale of stock, if a debtor pays us, we're going to record that in the cash receipts journal. If we earn interest on a positive bank balance, these four transactions will all result in an increase in our bank balance, and therefore we need to record these transactions in the cash receipts journal. Because remember, if the balance of the bank account, our business bank account, increases, that transaction needs to be recorded in the cash receipts journal. Documents are used to record these transactions. That there says a cash invoice. So if we make a sale, we can issue an invoice and keep the duplicate, even a cash sale, because now you get a cash invoice. If someone pays us cash, we issue them a receipt and we keep the duplicate. We can also get information off the bank statement. This is an extract of a bank statement sent to Calibu Education. We are doing the books for Calibu Education from the bank, and if there was an entry for example, interest on current account, in this credit column, that would increase our bank balance, and the transaction would have to be recorded in the cash receipts journal. Also, this is supposed to represent the cash register roll. If we had a till and we make a cash sale, inside the till will be the cash register roll, the duplicate of the cash register roll, and we will use that document to record information in the cash receipts journal. So here are 4 documents that can be used to record information in the cash receipts journal. We will focus on the receipt. So when we receive cash, we issue a receipt and we're left with the duplicate. So if we look at this example here, services rendered, so Calibu Education, we're keeping the books for Calibu Education, rendered a service to the school, but it was for cash. So what happens is the school pays Calibu Education for the services rendered. Calibu Education issues a receipt, the original, to the school, and then Calibu Education is left with the duplicate to record the transaction. So services rendered for cash to the school pays Calibu Education issues a receipt to the school and is left with the duplicate. Now you'll be required to record this information under the following column headings: number or date, depending what they give us. So this, let's say it is the 1st. We used a receipt to record this information as Calibu Education, and as I pointed out, it was the duplicate because the original went to the school. The bank balance would have increased. So according to the definition of the cash receipts journal, any transaction that increases the bank balance needs to be recorded in the CRJ, cash receipts journal. Now the accounts that are debited and credited, we've done this before. Bank would be debited. Increase in assets, there it is. So bank would be debited and services rendered would be credited. Services rendered is income, and an increase in income according to the rules gets credited, and the amount was 1,000. You are going to have to be able to complete this table, and that's easy enough. That column, number 1, the document you will get from the transaction, receipt, and put in the number 001. It's harder to work out whether it's the duplicate or the original. In this case here, Calibu Education wrote out a receipt and gave it to the school as proof of payment. The duplicate was left to record this transaction. So that's why in this column we write duplicate. It goes through the cash receipts journal, and then we got account debit bank, increase in assets, account credit services rendered, increase in income, and the amount is 1,000. So the account that is debited and credited, you first need to classify those 2 accounts. Well, first you need to identify which accounts are involved, and it's bank and services rendered. We've done that before. Bank is an asset. Bank has a positive bank balance. An increase in assets says bank account must be debited. An increase in income, the rule says the account must be credited. So services rendered here is credited, and the amount was 1,000. Right, next transaction. It says on the 12th, cash sales of stock 7,500. The stock that we are selling cost us 4,000. This was a cash sale. We received the cash straight away and issued receipt 002. This will result in our bank balance increasing because we received cash. Therefore, we must put this transaction into the cash receipts journal. We're once again selling items to the school. The school paid us straight away. So we issue them a receipt as proof of payment. Calibu Education is left with the duplicate receipt, which Calibu is going to use to record the transaction. Now remember, when there's a sale, there are 4 accounts involved. The date is the 12th. The document, receipt 002. It's a duplicate because the original was issued to the customer. The bank balance increased, so this transaction must go into the cash receipts journal. Part A, record the sale. Our bank balance increased. Increase in assets, debit. The sales account increased. Sales is income. An increase in income, credit, and then we record the sales amount. Now part B, we need to expense the stock. We need to record the cost of the sale. Cost of sales is an expense. An increase in expense must be debited. So that's why cost of sales goes under account debit. We got rid of stock because the customer, the school, took the stock. Stock is an asset, but in this case here, it was a decrease in assets, and the rule says credit. We've gone through these rules before, so this should be familiar to you. So that's recording a cash sale. There's the document, whether it was the original duplicate. The journal was the cash receipts journal. Then we got the 4 accounts, record the selling price, and that is the cost price, the 4,000. Now, the school also has an account with us in this transaction here. So the school is also a debtor of Calibu. Calibu has been selling to the school not just cash, but on credit. Now it says on the 14th, the school paid and settled its account with us. So we've had a whole lot of transactions with the school, and now the school has decided on the 14th to pay us. So if we're receiving the money, there it says paid, our bank balance will increase, so it must go through the cash receipts journal. We issue the receipt and we're left with a duplicate. Now the problem here is there's no amount specified. So we're going to have a look at all the transactions on credit with the school. We're not concerned about the previous cash transactions because we've received that money. We need to go and look at the school's account in the accounts receivable ledger. But let's just have a look quickly before we calculate the amount at the other columns involved. This is simple enough. The date was the 14th. We issued receipt 003 there, they tell us. Once again, we left with the duplicate which we used to record the transaction. Our bank balance increases from the money that we've received. It must go through the cash receipts journal. Account debit is bank, and account credit is accounts receivable, or you might call it debtors control. This one here is an increase in assets, and that one there is a decrease in assets. But the problem is, what is the amount? Now what we need to do is we need to refer to all the transactions with regard to the school where credit took place. I will show that to you in a moment. So the problem is now, how much did the school pay us? I've taken this just as an example. You don't need to know all of this, but the school entered into all these transactions during the month, and that information on a daily basis was posted to the school's account. I'm just going to write account. This here is the school's account in the debtors ledger. You don't have to know the debtors ledger at the moment, but you need to take into consideration all the transactions that have taken place with regard to the school, all the credit transactions that have taken place with regard to the school, not the cash transactions, because those transactions were already paid for. So what I've gone and done is I've just made up a few examples. If you got this in a test, you would have to go and look at all the transactions relating to the debtor in order to get the amount that is settled. So on the 9th, I've made these up. Caliboo sold to the school 3,200. On the 10th, of that 3,200, 1,000 of the stock was returned. Maybe there was faulty stock, maybe it was the wrong order, but 1,000 was returned. So after this first transaction, the school owed us 3,200, but then 1,000 was returned. So now it will be 2,200. 3,200 minus 1,000 is 2,200. Then there was another credit sale to the school of 3,000. Then only did the school pay. So these three transactions, which I've made up to illustrate this, took place. And now the school is paying us on the 14th what is owed. And I did this calculation taking the information from the transactions here in blue. I will work through this slowly. So 3,000, oh, wait, there's information up here. You must always look for an opening balance. It says on the 1st day of February, the month that we are looking at, the school already owed us up here 1,200 Rand. Then these transactions for the month started taking place. So then they owed another 3,200. Then there was a return, which I've put in brackets here. On the 10th, there was a return. Then on the 13th, there was a sale of 3,000. So it added more. So we got the opening balance, 1,200. Let's see if I can change the color here. See the 1,200? That was the opening balance. The information is given to you in the left-hand top corner here. Then there was a sale. So that's making what the school owes us even more. Then there was a return. So we take off that 1,000 Rand. Then there was another sale, 3,000. Now if you say 1,200 plus 3,200 minus the return 1,000 plus 3,000, the settlement amount is 6,400. The transaction says that the school settled what was owed, the full amount, so 6,400. So you're going to have to do this calculation by looking at all the transactions that relate to the debtor, in this case the school, and you're going to have to add all the credit sales and subtract the returns. Don't forget about the opening balance. in order to get the amount that was settled. So the transaction read, the school paid and settled its account with us, issued receipt 003. There's the school. All the transactions get recorded in the debtors ledger, the school account. We would just go there and find the final balance, but you don't have to do this at this stage, but you still need to calculate the amount. The date was the 14th. They paid us. We issued them a receipt. We left with the duplicate. Our bank balance is going to increase, so it goes in the cash receipts journal. Bank, the account gets debited because bank is an asset. Increase in assets, the rule says debit. Accounts receivable gets smaller because the amount the debtors owes us decreases by the amount that was settled. And now we're trying to calculate the amount. And the amount was 6,400. Given by, in the top right hand corner here, I showed you how to calculate that amount of 6,400. We look for the opening balance plus the sale less the return plus the next sale gives us the settlement amount. You are going to have to calculate this amount by taking into account all the credit transactions that relate to the debtor involved. If that's not clear, you need to watch this video again. Right, let's move on. The bank statement showed a credit for interest earned on a positive bank balance of 150. 150, we get this bank statement from the bank. It gets sent to Calibu. On there we haven't recorded this information, but now we have the information because we got the bank statement. Our bank balance is increased by the interest on the current account. The date's the 28th. Where did we get the information? From the bank statement. The bank sent us the original. Because our bank balance increased, it goes in the cash receipts journal. We debit bank, increase in assets, and we credit this account, interest on current account, increase in income. And they gave us the amount. It was 150. I did that quite quickly. Watch it again if you didn't understand it. Then I've just put in here an example of a completed cash receipts journal. You would have columns for bank items which occur quite often, debtors paid us, sales, there's a cost of sales column. We're not doing the journals, but you're going to have to record the transactions on the accounting cycle table, which I just did a few transactions on, but I'm just showing you what a completed cash receipts journal looks like. You total up all the columns, and what would happen at the end of the month, these totals would get posted to the general ledger accounts. That's the accounting cycle. So that's what a cash receipts journal looks like. We've just covered the cash book receipts where the bank balance increased. Now we're going to look at the cash book payments, which records any transaction that results in a decrease in the balance of the business bank account. So now we're looking at payments where the bank balance, our business bank balance, decreases. Any transaction that results in a decrease in the business bank account goes into the cash payments journal, also known as the cash book payments. I just went and put this in. There are many ways to make payments. There's PayFast, Yoko, I don't know how to pronounce that, Ozo, Ozao, Zappa. I use Zappa myself. It's very convenient. You just scan a QR code on the bill, make a payment. But in business, we're going to be dealing with EFTs, electronic fund transfers, where we make payments and money is transferred from our bank account to the supplier's bank account. Right, there also card payments can be made. People use e-wallets, PayPal online, MasterPass, but what we're going to be doing is EFTs, electronic fund transfers from our business to our supplier's bank account. So we've already mentioned any transaction that results in the bank balance going down will get recorded in the cash payments journal. For example, we made an EFT to pay wages 7,500. There's the EFT confirmation slip 1234 journal. Bank balance goes down, goes into the cash payments journal. Bought stock from the computer store, paid by cash, or it was cash, paid by EFT, cash payments journal. Then we're going to pay a supplier or a creditor, and we pay by EFT. This is just a little example of a EFT confirmation slip. So let's look at this transaction. Made an EFT to pay wages 7,500. There's the document. And if we have a look and we record it in this table, there is the answer. The date, or number 6. There's the EFT confirmation slip. Now just a little bit of extra information. The South African Revenue Services don't take the EFT confirmation slip as the document that proves the payment. You need to get the document that goes with the payment. You're not going to make a payment unless you've received an invoice, or in this case here, a bank statement. Right, when we receive the bank statement, that can go with the EFT confirmation slip. But what you can do in the test, we will accept EFT confirmation slip or EFT slip 1234. But I'm telling you, for more information, you need the document in order to make the payment. Say, for example, you received an invoice or a statement from a supplier. You need that as proof of why you paid these people. Okay, this EFT confirmation slip is the original. The bank balance has decreased. It's going to go into the cash payments journal. The two accounts involved: wages and expense. Increase in expense, the rule says, account gets debited. Our bank balance decreased. Account credit, bank. Why did we credit bank? Decrease in assets. So there is a transaction, paid wages, and the amount was 7,500. Remember, you're going to have to complete this table. Nice thing about the table, the examiner can ask all 5-6 journals without getting you to do the journals in a table like this. Right, next transaction, bought stock from the computer store, paid by EFT. Now this here is a cash transaction. We have bought stock from the computer store. So what happened was, the computer store sent this, or gave us, and we are Calibre Education, this tax invoice. Then we made a payment, the EFT, and there's the confirmation slip. So these two documents would go together. The EFT paid this invoice, and the payment was made to the computer store. And if we look at how to complete the table, there we have a look. Date was the 25th. They give us the EFT confirmation slip. I've just gone in order, chronological order. The last one was 1, 2, 3, 4. So I made this one 1, 2, 3, 5. It was the original that we received. The EFT confirmation slip was the original. Our bank balance went down, must go through the cash payments journal. What did we purchase? Trading inventory. Trading inventory is an asset. Increase in assets, the account must get debited. What happened to our bank balance? It decreased. Bank is an asset, decrease in asset, account credit, and the amount was 10,000. Right, settled our outstanding balance with the computer store. Now we have an account with the computer store, so anything we've bought on credit we need to settle. And on the 28th of February we are now settling the amount owed to the computer store. So similar to when we receive money from a debtor, we need to calculate how much money we received. In this case it is how much money we are paying. So it's the 28th, EFT confirmation slip. We get a statement from our supplier, the computer store. We attach it to this EFT confirmation slip, or we enter it onto the software. The document is the original. Remember, you can put EFT confirmation slip in a test, that's okay, and it's the original. How did we make the payment? By EFT. If our bank balance goes down, it goes into the cash book payments or cash payments journal, same thing. The amount that we owed to our creditors has decreased. We debited because the rule says a decrease in liabilities, the account must be debited, and a decrease in assets, our account must be credited. But how do we calculate the amount that we settled? Now once again, I've just taken a few transactions to explain this. On the first day of February of this month, we owed the computer store 2,400. During the month, transactions took place with the computer store, our supplier. We kept a record in the creditors ledger, accounts payable, of the computer store. And if you went to this ledger and to this account, you would see, because all these documents that we received from the computer store, or transactions with the computer store, or credit transactions with the computer store, would have been recorded in this creditors ledger, in the account of the computer store. So I took these transactions and I said, on the 9th, we bought from the computer store 3,000. We returned some of the stock to the supplier, the computer store, 1,200. Goes through the creditors allowance journal. So I took all the transactions that related to the computer store, not the cash purchases. Then we bought goods on credit, 3,000, another credit purchase, and then we paid. So after taking into account the opening balance of 2,400, the credit purchases, the returns, and another credit purchases, we can calculate the amount that gets paid to the supplier. And there I did some workings there. So if we look at the top right hand corner, how I got that 7,200, I took the opening balance, I took the 3,000 purchase, the 1,200 return, and another 3,000 purchase. Remember, you take off the return because you're not going to pay them for goods that you returned. So 2,400 plus 3,000 minus the return 1,200 plus the 3,000 is 7,200. So this took place on the 28th. We settled what we owed to the computer store. The document we used was the statement from the computer store, but more importantly for you, EFT confirmation slip number 1236. It's the original. Our bank balance is getting smaller. Cash payments journal. The amount of money that we owe has decreased. A decrease in liabilities, the account gets debited. Accounts payable is a decrease in liabilities, it will get debited. Bank, a decrease in assets, the rule says the account must get credited. And we just calculated the amount, 7,200. And if you want to pause the video or go back, that is how we calculated the 7,200 up here in the left corner. And then we have an extract of a cash payments journal. That's what a journal would look like. There's the journal heading. I've written here CBP, can be CPJ, cash payments journal. That stands for cash book payments. Same thing, different name. Then we will total up these columns, but in this is just an extract, so the totals aren't here. You're going to have to do the transactions, not in the journals, but on the cycle table. So there we go. That now is an example of transactions recorded in the cash payments journal. Right, the petty cash journal. Remember, petty cash is cash that we keep on the premises in order to pay for small amounts. For example, paid Telkom, the telephone account, 300 Rand. The owner used some money to buy some stamps. Paid for the courier. Purchased some refreshments. Withdrew 50 Rand from petty cash drawings. So these are tiny little transactions amount wise. Instead of doing an EFT, you keep money on the premises for these little payments, cash. When a payment is made, the person that's received the cash from the petty cashier needs to keep a document as proof that the goods were bought. Then that document could be a cash tax invoice or a slip, needs to be attached to the petty cash voucher. So the petty cashier, the person who looks after the petty cash, is going to write out the petty cash voucher, and this document will be used to record the transaction in the petty cash journal. So the petty cash journal records any transactions where petty cash is used to purchase an item, small items. Petty cash is an asset. And if we had a look at just one example, yeah, the owner took 500 Rand for personal use from petty cash. Just put in there the date, the 15th. The document will be the petty cash voucher. This is an internal document, so the person doing the bookkeeping will use the original. The information is recorded in the petty cash journal. Account debit here is drawings. An increase in drawings, the rule says debit. And what happened to the bank balance? No, the petty cash balance, which is an asset. The petty cash balance went down. Decrease in assets, the account must credit it, and the amount is 500. So that's just one example there of the petty cash journal. Now what I'm going to do, this is gone for 40 minutes. I'm going to stop here, and the next video I make will be on credit journals, the debtors journal and the creditors journal, and the returns or allowances journals. But before I go, I just want to show you a petty cash journal. You draw up the journal. What you purchase normally gets put under details. There's the petty cash voucher numbers. columns for sundry, right, columns for transactions that take place regularly, postage and stationery, staff refreshments. Right, so that's what a petty cash journal looks like. But remember, you are going to record transactions on the counting cycle table. So in the next video, we're going to start with the debtors journal. Then we'll move to the debtors allowances journal, the creditors journal, creditors allowance journal, and the general journal. See you soon. Cheers. Bye.